Hey, thank you, everybody. Thank you for giving me your time this afternoon. Thank you, Kevin and Kathy, for having me on Online Trader Central. Just a little bit about myself quickly. I'm a graduate of the University of Pennsylvania and former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years. I began trading the futures and forex markets about 10 years ago. And at that time, I first got involved in the optimization of software systems via the use of mathematical modeling. And just a little bit about the kind of business that we're really in. I mean, this is a really unique business. I mean, a lot of people present here. There's give presentations about their software. Many vendors ask you to buy software or buy trading techniques that you cannot even see until after you buy them. They come with back-tested strategies and entries. And the one thing that they always fail to do, I find, is that they do not give you mathematically quantified predictive values for their entries. And we're going to go over that a little bit because I think that that's key. That's a key metric to allow you to determine the value of the system. And many of the systems that they proffer are just plain broken. And to give you a quick example, there's a system that I've seen in which a stochastic oscillator is used on a Renko bar based chart, and the oscillator determines movement from area of support to area of support, or area of resistance to area of resistance. And the fact is that this is just basically, if you understand the mathematics of the stochastic oscillator, you realize that this system cannot possibly be effective. And the reason is that in order for the oscillator to work, there has to be three numbers that go into the equation. There has to be the high of the move, the low of the move, and the close of the move on each bar. So if you're trading a tick chart, a time chart, or a range chart, or a Renko chart that's modified to have a wick, then the oscillator line is allowed to appropriately trace out. And I can show you that here. If you're trading a range chart, which is the chart that which I like to use, and I'll show you why later, this yellow line can trace out appropriately based on the high of every move, the low of every move, and the close of the range bar. But if you look at a Renko chart, you can see that you have a high and a low of every move, but you don't have the open or the close of the bar. Therefore, the stochastic line, the yellow line, cannot trace out appropriately. So this system is flawed from the start, and cannot possibly provide you with any useful information. So no stochastic can trace out an appropriate line on a Renko-based system unless it's a modified Renko system that provides you with the wick. So it's really important for you to understand the nature of the indicators, what they do, and how they arrive at their calculations, in order for you to make an assessment of the value of any trading system. Now, really, they're basically a number of different underlying strategies that software developers take when they develop a program to define market direction. And all of these different strategies have very, very ardent supporters. And I'm not here to tell you there's any absolute right or absolute wrong. I'm simply here to tell you what we believe to be the best mix. Now, first are the price action people. And they believe that based on price action, based on their assessment of candlestick formations and the way the market moves, they can provide you with a buy-sell recommendation that has a positive predictive value significantly high enough to make you a profitable trader. Then there are those that use indicator analysis, and they believe that there is some unique composition of indicator signals whereby, say, they can trigger a blue dot buy to go long or a red dot signal to go short. And that provides you with a positive predictive value again. And now The predictive value is based on the sensitivity and specificity of a buy-sell trigger. These are all mathematically defined parameters. And without you knowing whether a trading entry is sensitive or specific, and understanding the positive predictive value of any indicator analysis-based signal, you cannot know if this is going to be an effective software platform for you to trade. Now, a further subdivision are those that trade one time frame and those that use higher time frames to confirm the validity of their entry. And I think that we would all agree that if you can look at multiple time frames to confirm the validity of the entry, it does increase the predictive value, the positive predictive value of the entry. The problem with that is that looking at multiple time frames can be very cumbersome and difficult. So at Rightline, we sort of reject and accept all of these hypotheses. We sort of use an amalgam of everything. Now, we don't believe that price action alone provides you with enough predictive value to get you to profit, to get you to profitability, as I mentioned. So we don't really agree with the price action people, but that's simply our mantra. Now, we don't believe that any confluence of indicator signals without a keen respect for price action is also going to work. There's no buy on the red dot, sell on the blue, buy on the blue dot, sell on the red dot system, whether it's black box or whether the software developer clearly explains to you what generates the blue dot or the red dot signal that's going to provide you with a predictive value high enough to get you profitable. Now, if either of these were true, if price action could get you where you want it to be, or if some confluence of indicator signals could get you where you want it to be, then it would be very, very easy to create a trading robot. At every time this indicator confluence triggered a blue dot, the robot went long. Every time it signaled a red dot, the robot went short. And that's all you would need to trade to become profitable. And we have never seen anybody do that. Although I have to tell you, we're there, but we'll get to that later. But it's only, and the reason we are there is because we take into account multiple time frames, price structure, and indicator confluence. But I'm getting a little bit ahead of myself. So what the goal of Rightline trading is to combine market structure. We have a profound respect for market structure. And we believe that market structure comprises about 80% of the information that's required in order to take a successful trade. Without respect to market structure and without a respect of market structure, indicator analysis and fractal analysis are essentially rendered ineffective. Now, we also believe that indicator analysis is important because it is a metric that defines for us market sentiment. I mean, we want to know if the people who are trading the market are bullish or whether they're bearish. So we use indicator analysis to confirm what we see in market structure. And then thirdly, fractal analysis is simply the assessment of multiple time frames at the same time. So what we do is we have our indicators analyze data from multiple time frames and project them onto your trading chart. So essentially, you're looking and assessing multiple time frames without having the burden of having to look at multiple windows. And that's what our indicators do, and they relieve you of that problem. And we've combined all of this into a simple trading program, and it's been optimized mathematically. I mean, it's been retrofitted based on a year of market replay data to provide us with entries with a positive predictive value high enough to make you a profitable trader. Now, part of our This is really, I think, extremely important and really a core part of becoming a profitable trader, and that is our trading methodology. And you're going to see um, when I show you our charts um, exactly how this plays out. Now, we do not call tops or bottoms, and I have never seen in 10 years of trading any software system that can effectively call a top or effectively call a bottom. I've seen oscillator divergence, MACD divergence. I've looked at order flow, all types of support and resistance signals, and they can do it, but they don't do it with a predictive value high enough to make you successful when you apply an ATM strategy and try to make a living out of calling tops or bottoms. That simply does not happen. And we don't trade reversals, which is really just another way of saying we don't call tops and we don't call bottoms. The other thing is we don't counter trend trade. Our software defines the trend for us, and it's our goal is to get on board with the trend. We don't buck the trend. And we do not try to predict breakouts. That's another thing that a lot of software systems do. I've seen numerous software systems supposedly that are geared to try to get you into a breakout but keep you out of false breakouts. I have never seen that happen, and I've never seen it done with any kind of success. Again, that's going to make you a profitable trader. Therefore, there's only one thing left, and that is to trade with the trend and to get on board with the trend early and safely. Now, it's our belief that institutional traders set the trend, and we want to be on board with them. And it's our goal to define a trend early and get on board quick. And most importantly, get on board safely. Now, here's a chart of crude oil, and you can see that these are all candlesticks. This is an 8-range chart. Now, the price action people would say that there's enough information present on this chart in order to trigger a buy or trigger a sell, and I don't believe that to be the case. I mean, you can see that this is an engulfing candle right here that calls for a reversal here. And in fact, if you look at this as a low, and then it moved to the top, then it moved to the bottom. This is almost 100% retracement. If you're looking at Fibonacci as a possible turn, then you have an engulfing candle here, and the market moves to the upside. That happens to be a very, very nice trading pattern and a really nice reversal call. But these don't happen often enough to make you a profitable trader, unfortunately. So you need more than just price action to drive you to profitability. So the first thing that we add is a 50-period moving average. It's just a simple 50-period moving average. When it's moving up, it's green, and when it's moving down, it's red. And we define our buy-sell zone. We believe when price action is above the 50, the bulls are in control. When price is below the 50, bears are in control. We only go short below the 50, and we only go long above the 50. If we try to take a move down above the 50, we believe we're counter trend trading, and we don't do it. If we try to take a long below the 50, again, we believe we're counter trend trading, and we don't do it. Our anticipation is always for a retracement and a move back down below the 50, and a retracement to the 50 and a move up above the 50. So here's our buy zone, and here's our sell zone. Then we add what's known as our modified 15. It's this line here. When it's yellow, we believe that defines chop. That's when we do not want to trade the market. When it's red, that defines a downtrend, and when it's green, it defines an uptrend. Now, when the 50 and the modified 15 are red, we're in a confirmed downtrend. And when the 50 and the modified 15 are green, we're in a confirmed uptrend. And this is when we want to go short, and this is when we want to go long. We want the 50 and the modified 15 to be in sync. Now, one thing about trading is it takes patience, and August price volume has been really pretty bad, and the market's been choppy. There's been a real lack of volatility in market movement. So sometimes it takes some time for the 50 and the 15 to come into sync. Sometimes we have to wait 45 minutes or an hour. But remember, if you want to be a professional day trader and you want to trade for a living, you have to learn to sit on your hands and not trade. And one of the most common mistakes I see make is overtrading, where people get bored and they take a trade because their gut instinct tells them to do something. If you do that, you're just not going to make it. What you have to do is you have to learn how to sit on your hands. Now, another thing that we add are our pivots. We set our sensitivity to 25 to only trace out major swing pivot highs, major swing pivot lows. Now, based on candlestick dogma, a pivot is broken when 2/3 of the candle body closes above or below the pivot. So you can see right here on this candle, 2/3 of the candle body closed below it, and the pivot's broken. Now, as far as pivots are concerned, we never trade into an unbroken pivot. We looked at a year of market replay data, and we calculated an equity curve based on ignoring these pivots and based on respecting these pivots. And the equity curve was far higher not trading into unbroken pivots than it was if we just ignored them and traded into them. So we know these are important parameters because we've looked at it and we've defined an equity curve based on respecting them. The other thing that we've looked at respecting and is extremely important is the open of the candle and the distance it is from the modified 15. Remember, it's important to trade on a long off support or a short off resistance. So we have another indicator, and this indicator, this 7, is an indicator. And it tells you when the candle opens, how many ticks the candle body is from support or resistance. Here, this candle body is 7 ticks off support. We already know, because we've looked at a year of market replay data, that we want this number to be no more than 4 ticks. We want these trades to come tight off this modified 15 simply because it's a strong area of support and resistance. And if you look at this candle, this is trading right off support. This is the kind of perfect setup to take it long. And it's hard to guess or estimate when you're trading. You've got so many things to look at. So the number is just there right in front of you. You can see that if it's a 4 or less, you're good to go on the trade if everything else is in sync. But it's just a parameter that we've defined to help us get into a trade and get in safely. And again, the purpose of a trading platform is to define risk. And we want to understand what is the risk associated with taking a trade long or taking a trade short. Our platform defines all of the parameters that are important in taking a trade. We know what our risk is when we get into the trade. Now, is it possible to take a trade when it's 5 ticks or 6 ticks off the modified 15? Yes, because 10% of trading is based on discretion. But the fact is, we understand that if we do it, we're adding additional risk to the trade. And if we want to stay super safe, we're going to keep this number 4 or less. Then we looked at the 3 indicator we believe are the most important in trading. The first is order flow, the second is stochastic, and the third is momentum. So we wanted to create an easy way to look at these 3 parameters, and also an easy way to look at these parameters on multiple time frames at the same time. So we created the 3-line indicator. And the 3-line indicator Line 1 is order flow, line 2 is stochastic, and line 3 is momentum. Now, if when any one of these lines is red, it means that the parameter that we're looking at, and let's just take order flow for instance, if it's red, order flow is down on all time frames. If it's green, order flow is up on all time frames. If it's blue, order flow is up on the long-term time frames and down on the short-term, but since long-term time frames rule, it's okay to take a trade when the line is blue. When the line is orange, it means you are down long-term time frames, short up-term, but again, since long-term time frames rule, we know it's okay to take a short. Now, this is a lot of stuff to look at when you're trading. So what we did was make it unnecessary to even look at the 3 line. Now, it's down there doing its calculations and changing color, but we project all the information that it acquires for us and projects it onto the price bars, making it a lot easier to do your analysis and determining where your best entries are. And to take an example here, remember, as I mentioned, we always trade with the trend and we only go long above the 50. You can see our modified 15 is green, our 50 period moving average is green, and the candle's outlined in blue. Now, the software does all its calculations intra-bar, so you're going to see this blue frame, and you can change the thickness and you can change the color. I just like it to be blue. These are all settings that can be modified, but it's going to outline this candle intra-bar. Once you see it, we have a range maker which tells you where the bar is going to close to the upside. You set your buy stop limit or buy stop 1 tick above the close of the candle. You're in, and you take a move to the upside. That's the thing I like about range bars. You don't have to guess where the candle is going to close. We are sitting in the trade before the candle closes. And if the trade matures to the upside as we like it, and then goes 1 tick above the close, we're in the trade. Here's the same information, order flow, stochastic, and momentum projected onto the price bar on a break of support to the downside. You can see the candles outlined in yellow. Again, we're trend trading. The modified 15 and 50 are both red, defines the downtrend. We're below the 50, down we go to the downside. Again, here's a break of the modified 15. Again, always with the trend. The 50 and the 15 are red. We break all support. The candle's outlined in yellow, which means we have order flow with stochastic and momentum in our direction, and down we go on the trade. Now, one of our major goals is to trap other traders. I mean, if we make money, and there were a couple of people in the room today. I mean, we did really well in the trading room today, and they happened to mention how we lightened other people's wallets. And a lot of people don't think about the fact that if you make money, you're taking that money out of other people's pocket. I mean, the market doesn't create or destroy money; it just changes hands. And sometimes it doesn't really occur to us. But if we make money, we have to take it out of somebody else's pocket. So what we're looking for is we're looking for people who are doing exactly what we said we don't do. And let's see what these people are doing. Now, the A, the B, and the C that are traced out here are not done, were not put in by me on the slide. They're traced out by the software. An A prints anytime there's a trend. And a trend is any 2 candles of the same color that occur contiguously. So 2 red candles create a downtrend, and 2 green candles create an uptrend, and A prints. Then the market moves to the downside. Now, the market here breaks the 50 to the downside and is surrounded by yellow. So you have order flow, stochastic, and momentum with you. But remember, I said we don't counter trend trade, and this would not be a trend trade because the 50 is moving to the upside and the modified 15 is moving to the downside. So we can't take the short. So what we do is we let price action break, and then we wait for and we know it almost always happens quickly buyers step in, and that's what this B candle is. It's a pull-up candle in a down move and a pull-down candle in an up move. I simply like the Bs to be colored magenta, but you can color them anything you want. You can just let them color green if you like. But this is simply buyers stepping in, deciding that the market has come down as far as it's going to come down, and they have decided to rush in here and take the market long. But the market doesn't want to go long. And what happens is they get engulfed. Now, anytime there's the potential for engulfment, a C starts to flash. And that means that we have a potential engulfing candle. And what we do is, from the range maker, we know the close of the candle. We set our sell one tick below the close. This would be a sell stop limit order. One tick below the close is C. And we're trend trading. The 50 is now rolled to the downside. The 15 is now red. And we've got the C candle engulfing all the buyers in B. And all these buyers are trapped because they tried to counter trend trade. They tried to call a bottom. And you can't do it. So what makes the C candle entry, and we have a number of different entries. I'll show you a couple of different entries. The most powerful is that there's two forces that allow the trade to continue to the downside. One is the addition of new sellers into the market, and two are all the buyers that are trapped here that get stopped out. And as they get stopped out, it helps push the C candle down. And sometimes you'll see that once this trade gets ticked in, the C candle just shoots to the downside. 4 or 5 ticks right into our first target. And that's because all of these people in the B candle are getting squeezed and getting electronically stopped out. Here's the same setup again. We could have taken this break to the downside, but let's say we missed the break of the 15. The market continues down. Again, these are the unfortunate traders who are calling a bottom. They've decided that the market's gone down as far as they wanted to, and they're going to counter trend trade. They're going to call a bottom. They're going to call a reversal. Well, the market is not ready to turn. We're in a confirmed downtrend, and at the very least, we're going to stand aside. We're going to wait for these people to come in and try to turn the market for us. And they do with that B candle. Then the C candle engulfs them to the downside, and we're still bystanders looking for the potential to get short. And what these are very safe retracements back into the 15. If we showed the metric that showed us the distance between the open of the candle and the distance to the modified 15, we would see that it's within 4 ticks. You're in 1 tick below the close of the candle to the downside, and down you go. Again, the same thing. This is a little choppier price action, but we're looking for some place in this move to the downside to get short. Now, the first thing that has to happen is we have to have the 50 roll and turn red, because we want to be in a confirmed downtrend. When the 50 and the 15 are not aligned, we have to stand aside. If we don't, we lower the positive predictive value of the trade and run the risk of getting stopped out, and we don't want that to happen. But you see, even though we can't take these trades because the 15 hasn't rolled yet, here's a bunch of buyers calling a bottom, calling a reversal. They get run over. And if you look at every down move and every up move, all you see repeatedly are people getting run over. Here are 2 green candles, and then a hammer. All people trying to call a bottom, trying to turn the market. Then there's complete market indecision. This is really a doji. There's no candle body here. Then the market continues to the downside. We finally get our B candle, our engulfing C, and now we can safely take the trade to the downside. We just took patience. We have the same thing with our momentum entries. Break, retracement into the modified 15, move up. retracement into the modified 15. You can see the candles outlined, order flow and momentum with us on this trade, order flow and momentum with us on this trade. We're always looking to trap somebody in the wrong direction because we are retracement traders, and a retracement is created by people who are trying to call tops and bottoms, and the market doesn't retrace it, and it retraces back to support. We get the signal to take it long, and they always get overrun. Now, we have very, very strict overbought, oversold parameters. And when the market gets overbought by our parameters, we don't go long anymore. Then we believe if people try to turn the market, they may do it successfully. But you're going to repeatedly get stopped out before you eventually get a good signal to turn the market in the opposite direction. Here's a momentum entry. Same principle. And you see, it gets a little bit redundant because really it's the same principle, guiding principle, that we trade with in almost all our trades. And that is the 15 is down, the 15 is down. We look for a move. We look for a retracement, which was created by people trying to turn the market at an inopportune time. We look to trap these people because as the market begins to its excursion back down, they get trapped, and as they get stopped out, they help push the trade to the downside. Same thing again. Break of the 15 and the 50, move to the upside. Retracement back to the modified 15, and that's a big move to the upside. Pair entry, same thing. Break of the 50, but the 50 is red. We can't go long. We wait for a retracement right back into the 50 and the 15, and up we go. Here it is again. We know we're in a confirmed downtrend. We just need a very safe place to take it short. We wait for these group of buyers to push the market right into the modified 15. The power entry signal comes intra-bar. We know when this candle closes to the downside, we're going to be short, and down we go. Now, if our trailing stop is very loose and we want to take additional risk, we have this whole move to the downside, all the way to the bottom. If we have a tight trailing stop based on our ATM strategy, we might get stopped out on one of these smaller retracements, but then if we do, we can take it short again, right here. When it retraces right back into the modified 15, we're in one tick below the close of the candle to the downside, and down we go again. This is strategy entry. Same thing. Move to the upside, retracement back to the modified 15, and up we go. Again, you can get multiple signals on the same candle. A break of the 50 and the 15, 50's green, 15's green. There's a move up, there's a retracement. This candle is outlined in blue. We have order flow, stochastic, and momentum with us. And we also have a strategy entry. It's an indicator that has a different set of logic to it, but tells us that that helps us confirm that the trend is intact. And we have the C candle. All of this tells us that the predictive value of taking an entry long and getting to at least to our first target is exceedingly high. Again, same thing. Break of the 50 to the downside. Candles outlined in yellow. Order flow, stochastic, and momentum are with us to the downside. Down we go. Now you're going to see this indicator in the upper left-hand corner. It has what's called the MA diff. And we also have a volume indicator, which actually ticks off the number of contracts traded as the day progresses. It gives us a really good feel for volume. And we do want to have some decent volume if we, in order to get good follow through. Now remember, we want the slope of the 15 and the slope of the 50 to both be red. Occasionally, the 15 slope can turn red before the actual line does. This gives us the heads up. But I don't want to make this any more complicated than it is because it's really quite simple. Now the MA diff, I'll show you what that does. In looking at a year of market replay data, we found that the oscillator is a very ineffective indicator to define overbought conditions. And if you think about how people use the oscillator to trade, you understand that some people, when the oscillator is oversold, they continue to sell as the market continues to break pivots to the downside. Because an oversold oscillator tells you one of two things. The bears are firmly in control, and therefore now is the time to go short, or it tells you that the market's likely to turn. Because once the bears have pushed the market into the oversold region, now you're looking to go long. So you have two schools of thought on how to trade an oscillator. And they both can't be right. The issue is that some people are right sometimes and others are right other times. What we found in looking at a year of market replay data is a predictive value of using an oscillator as an indicator to predict a turn is exceedingly poor. So what we did was we looked at a parameter, and that was what is the distance from the 50 where the market has moved so far that the regression to the mean becomes an overpowering force on the market. And that is when the space between the SMA 50 and the modified 15 is greater than 18, and that's our M8 diff, which is 12 here, and that's just on the right edge. When this is greater than 18 on an 8-range chart, we know that we're moving into oversold or overbought territory. Now, it doesn't mean that we absolutely can't take a trade. All it means is if we do take it, it comes with a little bit of additional risk. You see, we are simply looking to define risk and get us in safe areas. Now, you look here, if you look at the background, when the background goes pink, it tells you that order flow and momentum have turned red on additional higher time frames. And this chart is actually doing an assessment of 5 different time frames at the same time if you add the time frames it looks at on all the different indicators. And a couple of those time frame are tick charts. So it's looking at 3 different range chart settings, and it's looking at 2 tick chart settings. So now I'm going to drop these, and I'm going to go over to our platform. Let me just reshoot the screen for 1 second. I'm just going to resize the screen. And here's our market. Now let's take a look at how we traded today in the live trading room. Because I know that it's all well and good to see it on paper, but let's look at it live. Now here is where the market opened at 9:30 Eastern Time. The market opens. Now we're looking for areas where the 50 and the 15 are red and give us the okay to go short. Now you see this is a break of the modified 15, but the modified 15 was yellow on candle close, so we had no trade. Here was our first conservative retracement trade. It was right here. Now let me take off because I reviewed this with everyone in the room. What we had was a break to the downside. Whoops, hit the wrong symbol, I'm sorry. It was a break to the downside. There's our retracement right into the modified 15. And I missed the trade. I tried to put it in on a direct entry system. I missed it, but the auto trader took it. And the auto trader took an 11-tick trade on our 8-range chart. We take 2 contracts off at 5 ticks and 2 contracts off at 10. So this was a very, very good 2-target auto trader trade. But I kept looking, and the market fell. I'm sorry here. Again, we had people trying to turn the market, and I went short here. And I took it for 9 ticks. Then We got a whole bunch of junk. I mean, untradeable. The 15 and the 50 are not in sync here. So we know we can't trade. Finally, if you'll notice here, we get a strategy entry signal. The 15 is green, but the 50 is red. And of course, the signal fails. We don't take it because remember, we're waiting for the 50 and the 15 to come together. So we don't trade it. I mean, it's very definable. Then the modified 15 turns yellow. And again, we're sitting on our hands. We're waiting for the 50 and the 15 to come into sync. It does right here. I'm in one tick below the close of this candle here, and down we go for 10 ticks. A 2-target win. Now, on this particular candle, we were already done. We had our 3 trades and we were out. But here was another great trade. There are people trying to turn the market. We're in, one tick above the close, and this is a really, really big move. Now, once we get 3 wins, if we get 3 straight wins in a row, we don't trade anymore. But this would have been a 23-tick trade. And you see, all we do is wait for the 15 and the 50 to come into sync. And then we got our 3rd win off of crude oil. And although this looks like a lot of chop, when we define it carefully, it really isn't. Now, this was a break of the 15 and the 50 to the upside. Now, the way that the NinjaTrader platform works is that it recalibrates. The fractal indicators recalibrate when you close and open. When we traded this live, this candle was outlined with order flow, stochastic, and momentum in its favor. It was an outline candle. I took the entry 1 tick above the close, and up we went for 8 ticks. So we closed the day with 3 wins. On the Russell, we were +9 and +10. On crude, we were +8. We had net ticks at 27. These were all 8 range trades, 2 off at 5 and 2 off at 10. And I'll show. I have this written down, and I'll show you on a slide. When we hit our first target, the stop moves to break even. So our net equity was $640 for the day. The Auto Trader had 1 trade, the one I showed you. It was a second target trade. It had net equity of $300. If you were trading each in separate accounts, you would have made $940 today. Now we can go back on the Russell and take a look at a few other moves. And then I want to switch over to the Forex. Here is your bread and butter trade right here. This is the one where literally you can roll the truck up to the bank. The move down, the retracement right into the 15, and down we go. This is a C candle entry I would not have taken. I think it's in an oversold area, and actually something looks wrong with it, quite frankly. It doesn't look like a C to me. But I don't think this, I don't know what happened here. I truly, truly don't. Here's another trade. We have the break. Now, if I went through this bar by bar, you'd see how rarely you get a loss. This is not a huge win. We're looking for 5 ticks to our first target. This goes 8. It's a nice profitable trade. There's our C candle. I think it's a little bit off the modified 15 to take it, but it's another winner. And you get trade after trade after trade like this. You simply have to wait for the 15 and the 50 to come into alignment. And it happens multiple times on a given trading day. Same thing with crude. And I'll tell you, in the live trading room, I mean, we trade our software, and I see people in the room who are in our room. 90% of the trades I take in the live trading room that don't work are my fault. It's because I try to press a trade. I try to extend myself out. It's not a software issue. It's my issue. And that is the most difficult parameter to deal with, and that's the desire and the incredible impulse to get into the market and to trade your gut, and you just can never do it. And it takes a long time and a tremendous amount of patience. There's this great break to the upside, and there's your retracement. Now this trade comes back, and it's going to give you, it gives you grief, but it does not stop you out. And you're in one tick above here, above the close of that candle, and this is a 23 tick trade, and this occurs over and over and over again. Now let me show you the Forex market, because we are just releasing our Forex Auto Trader. Now, the reason I think our Auto Trader is so effective is because it takes the most conservative entries that I define for you here. Extremely conservative. Let me bring the Forex market over to you. Now, I want to move a little bit faster because I want to show you the direct entry system, and then I got a few more slides. This is a 5-range euro. The euro dollar. Now the Forex moves really, really well at night because of the European session. And here's a great entry. 50-15 down, down you go. Now remember, this is in pips. It's $12.50 a pip. So it's a very, very, very lucrative market. Here's another awesome trade. And you see them over and over. And the auto has infinite patience. And what I think is going to make it really great on the Forex is the Forex is a market that I can't stay up in the middle of the night to trade. I can't trade the European session right here. This is a 16 pip trade. So it gives you the ability to trade the European euro dollar, euro pound, euro yen at night without having to stay up and be bleary-eyed. And there's a tremendous amount of liquidity in this market. Liquidity is sometimes an issue on the Russell. It's never going to be an issue on the euro dollar, the euro pound, or the euro yen, and that's what our Auto Trader is going to trade when we first release it. And now what I want to do is I want to show you our direct entry system. Just hold on 1 second, we're going to connect it. Hold on 1 second, we're going to connect it up. We're kind of tech heavy here, and see, we need the market to move 1 tick to engage the direct entry system. And we have to move 2 ticks. Let's see if any market is going to move 2 ticks for us at all right now. Everything is frozen. Unfortunately, it's not going to move. I mean, what the direct entry system does is when I call out a trade in the trading room, I actually put the direct entry level into your Auto Trader. Into your Superdome. I put it directly onto your Superdome. Now here is, unfortunately, our waiting for connection, our own right line Superdome. It would unfold if it connected. I would simply put the order here, and it would transmit it directly into the Superdome. Unfortunately, I can't show it to you because we don't have a market moving that's going to connect it for us. So let me go back to the slides. If you haven't seen it in action, it's really it's pretty amazing. But I can't show it to you now because we're in a bunch of dead markets. Let me just resize the screen for the last time and go back to our slides. Okay. Now, on our 13 range chart, we have a 15 tick initial stop. We take 2 contracts off at a first target of 9, 1 contract off at a second target of 15, 1 contract off at a third target of 22. At the first target of 9, our stop moves to a 9 tick trailer. Now, we have to update these charts, but from the month of January through April, if you started with 4 contracts on a $4,000 account, you'd be closing in on $25,000 of net profit. And we post the profit every day. We're behind a couple of days, but that's just because we've been really focused on the auto and getting the Forex Auto Trader up. Percentage increase is closing in on 600%. Profit on the Auto Trader, for most of this time, it only traded 3 contracts, is approaching $10,000. And percentage also 600%. Now, what do you need? Essentially, what do you need to become a professional day trader? One is you definitely need outstanding software that's going to do 90% of the heavy lifting. Now, you saw from the live trades that I took today and from the trading setups just what we're looking for. But 10% of what we do is discretionary. Now, you can take that 10% of the 10% discretionary component of trading and use it to outtrade the auto trader, or you can use it to take repeated losses. So you really have to work. And pattern recognition is really, really important. And like I said, most of the time when we take a loss in the live trading room, it is not a bad signal. It's a bad trade. So that 10% discretionary component you have to work on, and it takes time. And because remember, we have to outfight the smartest and the richest people in the world who use very sophisticated trading systems. And we have to I should reword the slide, because we're not going to take money out of their hands. We are not going to beat the institutional guys, because these are the guys that define the trend that we want to get into. We are unfortunately pitted against the other small guys. And if we're going to take money out of their pockets, we have to do it. We have to be very, very patient, very diligent, and we really have to adhere to our trading rules. And that's why we believe education is such a really essential component to day trading. And we try to provide you at Rightline with extensive videos, group and personal mentorship programs. We really, really heavily support our software. We're here all day. People call us all afternoon. We don't sell you the software and then duck for cover and hide under a rock. We're here, and I trade this program every single day. Now, we never ask anyone to pay for boot camps, because I don't even know what a boot camp is. I mean, if you're not provided with enough information when you buy the software or you lease the software to trade it profitably, I don't understand why you need to pay additional money to boot camp it. I mean, I don't know what a boot camp is. I guess it's a penchant to take more money out of your pocket when you're not trading a particular software program successfully. The boot camp blames it on you, and if you pay more money and go to the boot camp, then you're going to become successful. If we hold seminars and lectures, we do it for free. The big thing is that we're constantly upgrading the software. We're looking for better ways to define risk and better ways to get us all into successful trades and make us profitable. And these upgrades are always free. We never come with a 2.0 version and ask you for more money. Essentially, if you're buying or leasing the software, we give you the upgrades, we give you the add-ons for nothing. And these are all, we consider everybody part of our trading family. And I'll tell you one thing. I think that we have a lot of respect for everyone's money. Everybody out there works really hard, and everybody in this room is looking for a successful way to day trade. And we really, really want to get you there. And it's really the philosophy of this company to try to get you where you want to be. Now we have a couple of specials that will be active on the website for a couple of days. One is is our entire software system plus the direct entry software. And normally we don't sell the direct entry software; we only lease it. That's lifetime license plus the video tutorials plus a 2-hour mentorship session with me and 2 months in the live training room for $29.99. Yes, we will. Absolutely, William. I'll go through all the questions. Now, the Forex Auto Trader is $3.99 per month. The Futures Auto Trader is $3.99 per month. The other webinar special is you can lease them both on a monthly basis for $4.99. Now, I'll take any questions. Now, I just want to know that there are guys in the room who already own the software and already have the Futures Auto Trader. If you already own it, you will get the Forex Auto Trader as an add-on free. You will not have to pay for it. If you don't own the software when we roll this out, the Forex Auto Trader you're going to have to pay for. So owning this at the time we release the Forex Auto Trader, just like everything else that we have, is going to be really advantageous for you. Now, let me just go over the questions really quickly here. We will be, William B. We will be. Are there any other questions? Thank you, RWO. Anything else that I can add on here that might help you? What? Oh, market. Okay. Somebody asked me about market structure. Market structure is simply the way that price action behaves. This is market structure. Let me take the slides up. Market structure defined really simply is price action above the 50 or below the 50? Is it above the modified 15 and above the 50? Below the modified 15, below the 50? In other words, market structure defines trend. And there's information in every single candle. When you have an 8-tick, on an 8-range chart, if there's 8 ticks, if it's an 8-tick candle body, that's a lot of sellers. They have not allowed the buyers to push that market up 1 tick and create a single wick to the upside. So that's all market structure. There's information in every single candle, and this occurs on time charts, tick charts, or on range charts, and that's what we mean by market structure. Absolutely, the trading room is available as a standalone. Excuse me. You can lease it as a standalone. No, it does not, Mitchell. You do not need You don't need to read the tape. Order flow simply compares the number of executed buys and sells at the current candle with the number of executed buys and sell with the previous candle. So it does the calculations for you. I used to read the tape for a long time, and chasing the tape is really, really a difficult thing to do. The order flow indicator does all that calculation for you, and adds it up for you. You do not. All you have to do is look at the color of the 3 line. It does the assessment for you on multiple time frames. Yeah, the auto is separate from the software. With the auto comes the direct entry system, Sean. We used to sell the auto trader, but we don't have very many auto traders available because once we hit 50, we're going to close it because we don't want to stuff up any single tick area. So we only have the auto trader available by lease. That's both the Forex now and the futures auto trader. So that is separate. And there are people in the room who have purchased the software when we did sell the auto trader, and they do own it. It's just not something that we do anymore. And eventually, we're not ever going to sell a direct entry system either. But right now, you can buy it. Now, here's the thing. I would like Leo to put it into the room, and then I'm going to stop because it's 5:31. I don't want to run over time. He's going to put a link into our room. I would like to invite everybody into the live trading room tomorrow and Friday. Now, these are rugged days because it's August and volume is lousy and price movement is difficult. By 11:30, the market's dead. But we want you all to come into the room and see how we trade. Now, we're going to drop the username and password on the room and then for the next 2 days. All you got to do is click on that link, sign up, and come on in. And you're in the live trading room. And you'll still have the opportunity to get any of the specials that you want after you come in. We will email. If you sign up, we will email you the link. The link will go out either tonight or you will get it about 8 a.m. Eastern time tomorrow. The room starts trading at 8:45 a.m. Eastern. So you'll get it about 45 minutes before the room opens, and you will get the link, Mitchell. I invite you in. No, there is a sign up. You have to sign up because we have people who are on there like their 14th. I mean, I don't want to run over, but there are people on there like 14th free trial. So we need to sign up. The link is right above you. MT. Can you put it in again, Leo? And then listen. Then I'm going to say goodnight. There's the link, the sign up link. We just need your name and your email address. Really, just ensure you're not going in there on your 14th trial, or your 5th trial, or your 3rd trial. That's all. And we want to see everyone in there. So, and Leo, can you put in the trading? I just put in the link to the training videos. This is a link to our proprietary training videos. So I want to make them available to anyone who wants to learn more about the system. Now listen, I've run 3 minutes over time. It's 5:33. I know Kathy and Kevin have had a long day. Kathy's already signed out. Listen, everyone, have a really, really wonderful afternoon. Thank you so much. Any questions, you can call us. We'll be here. But come on into the room. I explain all my trades. I think out loud. You'll see how we do. Everyone have a really, really wonderful evening. Everybody, good night, Toby. I will see you tomorrow in the room. Take care, everyone. Have a great evening. And thanks again, Kevin and Kathy. Bye-bye.
Hello, everyone. Thank you so much for your time and your participation here today. We sincerely appreciate each and every one of you. Please take advantage of Mark's offer. We will be closing the room now. Thank you, everyone. Have a great day trading tomorrow. Bye for now. Again, thank you.
Listen, can you just stop? I can't stop. Snag it. It won't stop. Hey, Kevin. No, snag it. Hold on one second. Hold on one second. I